So if you're doing business between India and China, you already know how fast payments for things like software or consulting can get all tangled up in tax rules. Today, we're going to cut right through all that confusion and focus on one absolutely crucial rule, Article 12 of the Double Taxation Avoidance Agreement. Let's jump right in.
Just imagine this for a second. Your company in India pays a firm in China to use a patent. Or maybe you're in China and you hire a consultant from India. The big question is, who gets to tax that payment? Is it India, China, or, and this is the real nightmare scenario, is it both? This is that classic double taxation trap we hear about, where the exact same income gets slammed with full taxes in two different countries. But thankfully, there's a very clear solution.
And this is the solution right here. Seriously, if you only remember one single thing from our chat today, make it this number, 10%. This one figure is basically the key that unlocks the whole agreement between India and China for these kinds of payments. It's the one rule designed to prevent that massive double taxation headache we were just talking about.
Okay, so here's our game plan. First, we'll dive deep into that 10% rule. Then, we'll get really specific about what actually counts as a royalty or a fee. After that, we'll see how the tax system works in practice, cover the critical exceptions you absolutely cannot afford to miss, and then we'll wrap it all up with your key takeaways.
All right, first up, the big one, the 10% tax rule. Now, this isn't just some random number they pulled out of a hat. It's the very foundation of an agreement built to make business between India and China a lot more straightforward and predictable.
You know, at its heart, this whole article is really just about fairness. It stops a situation where a company might pay, say, a 30% tax in India and then another 25% in China on the exact same income. I mean, that's just not sustainable. So instead of duplicating the tax burden, this agreement creates a system to share the tax revenue.
And look, this isn't just a friendly guideline. It is written right into the treaty itself. Just take a look at the official language from paragraph 2. The tax shall not exceed 10%. That very specific phrasing is what gives this rule its real power. It's not a suggestion, it's a hard cap on what the source country is allowed to tax. Period.
Okay, so we've got our 10% rule. But what does it actually apply to? You can't just slap the royalty label on any old payment and call it a day. The treaty is super specific, so let's break down exactly how it defines these key terms.
First up, let's talk royalties. This basically covers any payments you make for using someone else's intellectual property. Think about it like this. You're licensing a brand's trademark, or you're using a patented industrial process, or maybe you're paying for access to a secret recipe. It's all about paying for the right to use another company's valuable, protected asset.
And then we have fees for technical services, or FTS for short. Now this is different. This isn't about using property. It's about paying for someone's actual expertise. As you can see from the definition in paragraph 4, this bucket includes payments for things like management advice, technical support, or really any kind of consulting work. So the question is, are you buying a thing, or are you buying someone's help? That's really the core difference.
All right, now that we know the rule and what it applies to, let's get into the mechanics. How do India and China actually split the right to tax this income? It's a really clear step-by-step process.
So here's how it plays out. Step 1. The country where the company actually receives the money gets to tax it. Makes sense. But then, step 2. The country where the payment comes from, what we call the source country, also gets a piece of the action. And here's the most important part. Step 3. The source country's tax is capped at just 10%. So yeah, both countries get to tax the income, but one of them has a very strict limit.
But, and this is a big but, that 10% rule is not absolute. There are a couple of really crucial exceptions where this whole system gets turned on its head. And trust me, understanding these is just as important as knowing the rule itself if you want to avoid any nasty surprises.
The biggest exception, by far, revolves around this term, a permanent establishment, or PE. So what is that? Well, think of it as having a significant physical business presence in the other country. We're not just talking about making a one-off sale. We're talking about having a fixed base of operations there, like an office, a factory, or a workshop. And this makes a huge difference. On the left, if you have no permanent establishment in the country you're getting paid from, the 10% cap applies. Easy. But now look at the right. If those royalties or fees are directly connected to a permanent establishment you have there, that 10% cap is gone. It just vanishes. The income is no longer treated as a simple royalty, it's treated as regular business profits and gets taxed at the normal and often much higher corporate tax rates. All right, now for the second major exception you need to watch out for. What happens when the two companies making the deal aren't exactly strangers, you know? What if they're related, like a parent company and its own subsidiary? Well, the treaty has specific rules for that scenario too. This gets us to something called the arm's length principle. Basically, the 10% cap only applies to what two completely unrelated companies would have fairly agreed to pay. So if a parent company decides to overpay its subsidiary for a royalty just to move profits around, the treaty says, nope, not gonna work. Only the fair market value portion of that payment gets the special 10% rate. Anything paid above that amount gets taxed under the normal laws of each country.
All right, we have covered a ton of ground here, so let's pull everything back together and just quickly summarize the most important points that you really need to remember from all this. These are your essential takeaways.
First and most importantly, remember the 10% cap. That's your headline number. Second, understand that tax rights are shared, but they are also limited. Third, definitions are everything. You have to know if your payment is really a royalty or if it's a technical fee. Fourth, always be on the lookout for a permanent establishment. It is a total game changer. And finally, make sure your payments reflect fair market value, especially when you're dealing with related companies. And all of this leads us to one final thought. Now that you have a better handle on the framework of Article 12, the real question is one for you to take back to your own team. Are your cross-border payment structures truly optimized to navigate these rules? Taking a closer look now could save you from some pretty significant pitfalls down the road. Thanks for watching.